Hello guys and welcome back to the channel. So this is Wheeling with Vince episode number 2. This is the down-to-earth option series that I do on the channel, and I think it's new to most of you on the channel. I understand that this will take time to get going, so I really want to know, are you liking this series? What is the the data that you want to know, so I can gear it towards you. And also let me know from where on this planet are you watching this episode from. So in this episode, we're going to talk about selling put options, and I'm going to give you some very interesting strategies and one super advanced strategy that would allow you to buy Rocket Lab for about a cost adjusted basis of $21. So if you're interested in that, stay tuned. I want to go over what happened with my option portfolio this week. What are my thoughts about what's going on in the market? And then I'm going to speak about the strategies, and I want to take a few questions from you. Wow, I see people here from Toronto, somebody from Denmark, Henrik Gjörkös. Is that a Hungarian name? Wisconsin and New Zealand. Awesome. Welcome, you guys. By the way, I've had a very amazing day. I had a subscriber visit me from the US. He is a very big Rocket Lab investor. He made millions on Rocket Lab, and we spent the day together. I showed him some of our projects, the real estate projects. We ate in restaurants. I'm so freaking full, and it was super fun. Henrik, that's awesome. I'm also Hungarian. So very interesting. That's pretty cool. Anyways, let's get going. So what happened in the options portfolio this week? It's not much. I still have my Tesla short put option. Remember, this is a very deep in the money put option, and it's basically like synthetically owning the share. Because each dollar that the Tesla stock goes up, this option loses $1 from its value, and because I'm short it, I'm winning that. Then I have a call option written on Tesla that is against this put option, and that looks very good. It looks like it's going to expire worthless in a week because it's a $500 call option, and I think that is going to make me a cool. I need to check it for you guys. By the way, as I'm doing this, if you have any questions, feel free to put it in the chat, and as soon as I get to it, I will answer it. So that is a $6,896 trade, which looks like is in the bag at this point. And I wrote or sold this call option at the beginning of January. So for 1 month, that was $6,896. And I'm very happy with that. What I'm not very happy is I wanted to sell a put option on the 380 category on Tesla, but my margin did not allow me to sell that, because otherwise I would have made about the similar money on short-term Tesla put options. Then I have Enphase. Enphase has been really bad. I basically bought a long call option on Enphase, and that is because the price is really, really low, and I want to start writing call options. And because my cost basis on Enphase is over it's $100, so I'm very much under the strike price here. So if I would write a call option, and let's say at $80 or $70, and I really think Enphase is about to go over $100. Let me come back. It would be a very stupid business deal, because then I was made to buy Enphase at $100, and I got it. The stock fell down, and then I would have to sell it at $70, and the call options basically protect me against this. and I just want to wait for a swing, and then I would start writing call options because I'm protected with the long options. It's pretty maybe confusing a little bit, but it's very nice when you understand how this works. So this was basically how the option portfolio is doing. I didn't have a lot more time this week to prepare. I want to show you guys next week when you come on each stock, like on Tesla and M-Phase, how I'm doing with the wheeling strategy. I think Tesla was up about 40,000 and M-Phase was down about 20,000, I think, at this point. I just didn't have time to update it. But next week, I promise we're going to look at it. So again, if you guys have any questions, put it in the comment sections below. And while we are here, and we went through the portfolio now, so I want to speak about what can be the benefits of selling put options. And again, if you feel that this is too basic, let me know in the comments. If you feel this is too advanced, let me know. I really want to adjust the content to find, where the audience is at and provide you guys very, very good data. So selling put options, what does that mean? So a put option is that you're basically insuring someone else's stock. And like, let's use Rocket Lab because so many people here on the channel like Rocket Lab. It's easy examples. So let's say I bought Rocket Lab at $4 and the stock is at $30 now. And then I'm really worried that the stock is going to fall, but I don't want to sell my Rocket Lab. So maybe I can buy insurance and say that if the stock goes below 25, I want to be able to sell the stock to someone else for 25. So I want to put the stock to someone else for 25. So when I sell the put option, it means that I'm willing to take over Rocket Lab for $25, right? And now because I'm taking risk, Rocket Lab is $30. So it's not so likely that the stock is going to go back down to 25. Maybe if there is a pullback, it's only to 27 or 28. And I'm taking this risk, so I need to be compensated for that risk. And that compensation is called the premium. Now, there is a lot of ways to do selling options, and a lot of people advertise on YouTube that, when you sell options, you can make a monthly income from it and, yada, yada, yada. I think that's the wrong reason to sell put options. The correct reason to sell put options is because you actually see an opportunity or, the stock is in the perfect place for you to, like, for example, let me give you an example. So Rocket Lab is at $30 and you are eyeing Rocket Lab and you think it's overvalued and $18 would be a fantastic deal for you, right? Then you see the stock falling and falling and falling. It's imaginary scenarios. And the stock hits $20. Now, that time would be a perfect time to sell put options because you would get paid a lot because you're very close to the strike price. And you create what I like to call a win-win scenario. Because if the stock goes to 16, let's say, you were anyways going to buy it at 18. If the stock goes to 22, 23, then it never reached your stock price. You were waiting for the stock to reach the price that you wanted to buy it at. And you basically got paid for that time. So you in each, it's like heads you win. No, sorry, heads I win, tails you lose. Like you cannot lose in that situation. If you sell the put options because you need short-term money, that's when you're going to start making mistakes. And I made a lot of mistakes selling options like that. Kostadin, yeah, it's so funny. Welcome to the video. Hey Vince, I hope you're doing well. Given your experience, it would be a lot of fun to have a video on real estate. Yeah, I'm thinking about it a lot, and I talked to my colleague. We are thinking about starting something on YouTube with real estate. The problem is that My knowledge is very Swedish specific. Like I know super much about Swedish rules and how, like a lot of things you can do in Sweden. And I don't think they have a lot of value in the US, but I say if I find a way how to make it interesting and give value to an international audience, I promise I'm going to do it. Andy McConchy, I probably butchered that name. Okay, question. How does buying call impact your margin? That is a good question. I mean, the margin, because I think it depends on your broker company, how it impacts it. Believe it or not, selling a call option actually increases your margin a lot because you are insured a little bit if the stock is going down. And in interactive brokers where I am, let me see if I can show you. No, I cannot show you the picture. But on interactive brokers, that's the one that I have. On each transactions before you do it, it gives you a table of like how it affects your different margin metrics. So yeah, Kostadin, I have an idea. Yeah, definitely. We anyways should catch up. Actually, I wanted to speak to you. Cool. So I hope I answered your question, Andy. We go back to selling put options. So here is two strategies where you can use a put option. One is very, very safe. One is a bit riskier. And I'm going to give you a very advanced strategy and with some examples. We're going to use Rocket Lab as an example. So strategy number one is that you have money on your account. That's exactly what I said. And we are using Rocket Lab as an example. So Rocket Lab is $30. You want Rocket Lab, but you think the price is too high. And you have $100,000 sitting there. And then you're like, okay, I have this money and I'm just going to wait until Rocket Lab hits my target price. So what you could do in this case is, let's say now we take an imaginary number and we say that you want to buy Rocket Lab at $25. So you could sell a $25 put option and you would get paid. I mean, you can see the last transaction on that option was 135. So now I just want to show you how powerful that is because the 125 you divide it by the strike price of 25, that is a 5% return in 34 days for taking the risk of something that you would anyways do. And I really want to stress here that this only makes sense if you would anyways legitimately want to buy Rocket Lab at this price. If not, then I promise you, you're probably going to be assigned the share and you will be very, very unhappy that you sold the put option, right? Now, let's say that you want to, wait 3 months. You want to give yourself a leverage of 3 months because, you remember, you get paid for the risk that you're taking. So then you would, let's say, sell the 3 months $25 put option. That the last price on that is $280. So let me see how much money that is. So 2.8 divided by 25. So that is an 11.2% return that you basically get on your $100,000. And remember, if Rocket Lab never comes back down to this price, you just keep this money. So fantastic. You made $10,000 and you just keep this money. If Rocket Lab, let's say, goes to 24 or 23, remember, it's your adjusted cost basis is 25.258. So that means that your adjusted cost basis is $22.42. And you can ask me, yeah, but Vince, what happens if Rocket Lab would go down to 18? Now, remember, you were anyways going to buy it at 25. So basically, essentially, you have the same loss that you anyways would have had if you bought at 25, except you got paid an additional $2.58. So if you ask me, this is a very, very good strategy. Now, I want to show you something quite incredible here. And that is if you would sell a 1-year put option on Rocket Lab at $25 or even at $30, right? Your adjusted cost basis for the stock would be $9.45. Sorry. So $30 minus $9.45. So that's like buying Rocket Lab today for $20.55. That is pretty freaking good if you ask me, that price for Rocket Lab today. Is it risk-free? No. Remember, nothing is risk-free on the stock market. But that's pretty damn good if you ask me. So now I want to show you, let me just have the questions. I made great money wheeling Rocket Lab, but missed so much of the upside. I missed a lot selling cover calls on Redwire. That's a very good point. The same thing has happened to me, and that is because we did something wrong. So I consulted a lot with TJ, the Wheel Deal, and basically what you need to do is you buy long calls. Like if you're super bullish on the stock, like I was on Rocket Lab, then what you need to do is when you sell covered calls, you also buy long calls on the stock. And then if what happens on Rocket Lab, like the stock 5x's, right? Then the long calls, they protect you. And yes, you lose a little bit of money on the covered calls, but it's minimum. And if the stock doesn't go to the moon, then in like 1.5 months, the cover calls earn back the price of the long call, and then it's just insurance, basically. So I wish I would have known that a lot earlier, but that's the solution to that. Sold so many Rocket Lab puts today. Premiums were nice. Yeah, that's why I'm using that in the example. Would happily take assignment of Rocket Lab, but it won't happen. Even so, 28 and 29 strikes for today. What? You mean that the expiry was today and somebody bought it and you made money on it? That's funny. So it seems like that was like a 0-day option that you sold. Let me know how much money you made on that. That was basically free money, especially if you wanted to get assigned the shares. The downside seems to be that if Rocket Lab goes up by 20% in the time while you are waiting for the put option expiration to keep your 10% premium, you are missing out on the upside movement. Exactly. So again, I keep coming back to the point that this only makes sense if you would not buy the stock today. You would only add to the stock if the price hits a certain metric. Because if you just want to buy, like if you're happy with where the stock is at today, you should buy the stock today. Because yes, if you write a $30 put option and you're hoping to get assigned and the stock goes to $60, you're going to look like an idiot and you're going to feel very stupid. So you guys have to understand that selling options is a very different mindset than long-term investing for stocks. And actually what like I am doing, or I want to do more in the future, is separate my portfolios and have one part of the portfolio that is selling options for income and one part of the portfolio that is just long-term investment. And it's best not to mix the strategies. And as in the series I want to do, this is like a non-hype option weekly podcast, is that I believe if you're a good stock picker, you're going to have better returns than if you are selling options. So the selling options is only good if for some reason you need income from your investments. So I give you examples. You want to retire, but you don't want to sell your stocks. So you want to have your cake and eat it too. Then you can sell options. That is the situation that I'm in. My portfolio is together with my dad. My dad wants to retire, and one way to do it would be to close down our portfolios, sell everything, and then distribute the money. But I found this way of selling options, and my hope is that this year I can get the option income stably to $10,000, $15,000, $20,000 a month, and then my dad can retire and we can keep the stock portfolio. But if you're not in that situation, you're earning good money, you know, you're able to invest every month into the stock market and you're a long-term investor, you don't need to do option trading. You will probably do better just picking right stocks and sticking with them. Good. So we go back to what I was saying. So we had the strategy where you have the money on account and you want to buy a stock at a specific price. Now, here's another scenario. Let's say that you know that 2 months from now, you are getting money in your account. And 2 months from now, you want to buy Rocket Lab. So what you could do is then use margin, sell your put option, and you don't pay for the margin because you're not using the margin. You're just, how do you call it? You're just, the margin is just your security. It's basically like having a credit card and saying that, look, I insure you that if your TV breaks, I'm going to buy you a new TV. And then the guy says like, can you really do it? And you're like, yeah, I have this MX, I can do it, you know, and then fine. And it's very similar with the stocks. And I would only do this if you really have money coming in, because then you can just add an extra however many percent while you're waiting for the money to anyway come in. So now I want to give you a super advanced strategy that is, again, I would only use if you have a lot of experience and if you know that you have money in, and if you would anyways buy the stock. But I want to show you something. So if you sell a super in the money put option, like a long-term option, like let's look at the $45 put option on Rocket Lab, which you see the last price was $20.15. So that gives you an adjusted cost basis of 45 minus 20.15. So that is a $24.85 cost basis today. So that's the same as, again, buying Rocket Lab for $24.85. So now what's crazy with this is basically because the put option is so deep in the money that every time Rocket Lab goes up $1, this option will almost go down in value by $1. The closer you get to the strike price, the less the option value is going to go down. But why the heck would you do this? Oh, I'm sorry. Hope I didn't scare any one of you. I dropped the phone on the mic. What did I do? So why the heck would you do this? Now, one really cool thing with this strategy is that if you sell this super deep in the money put, you basically get paid. So instead of you, let's say you would want to buy $100,000 worth of Rocket Lab today. So that would be 100,000 divided by $30. That would give you 3,333 shares. Okay, so that's what you could buy today. That is 3,300 option contracts, right? So now instead you could sell. Sorry, the 3,300 is 33 option contracts. So instead you could sell this super in the money put option, and then instead of you having to put out $100,000, you would get paid the value of the option, which is 19. Let's we use this the last closing price. That's 2015. So 2015 times 3,300, you would get paid. That is 66,495. Now this money gets deposited on your account. You get interest on this amount. And each time Rocket Lab goes up $1, you basically win $1 on your 3,300 shares. Now, what's wrong with this, right? What is wrong with this is if Rocket Lab goes to $70, you only make money up to $45. So you limit your upside, and you miss out on that. So when would I use this strategy? So when I would use this strategy, one, I'm using it on Tesla and on Enphase, as I was showing you, because what it does is, yeah, instead of putting out money, you get money paid on your account. And for example, if you know, again, this is the same, like if you would know that I'm for sure getting money in, let's say, 6 months, I'm getting in $100,000, and you feel that, okay, if I sell an out of the money put option, and we go with exactly, we go with Mikael Bullish, I don't know if I said your name, comment that if you sell the put option and Rocket Lab goes up 30%, then you miss out on all that 30%, right? So if you sell the super in the money put option, you don't miss out, you actually get that 30%. And there's literally, it's basically better than owning the out of the money put option. Yeah, it's a very sorry, it's like the first time I'm explaining it to others, and it's not just in my head. I hope it's understandable how I'm explaining it. And I think that this can be a very, very good strategy. If you don't have the money today and you would want to buy it, then you can lock in the stock at a very, like, for example, Rocket Lab. It's like buying Rocket Lab today at $25. You lock in that price, and then your only risk is that if the stock goes to 100, then you miss out on anything over $45. So that was the super advanced put option strategy. So I hope that this video was useful. Mikael, thank you. You're saying I'm doing great. I hope you understood what I said. If not, just leave the answers in the comments, and if leave the questions in the comments. Jesus Christ, I can't speak today. And if you're watching this on replay, then just comment on the YouTube video, and I will either answer on the comment or I will make a video about it and take it up next week. Let me see, custard and chips. No, I sold puts at the beginning of this week. We would have a pullback. I was happy to take assignment, but we never got a pullback. I was about 7% return on 3 contracts for it. That is insane and very well done. And I want to applaud you, because you did something that you would anyways have done. It feels like you would have been happy to take assignment for the $28 put options, but it just never happened. So it was like a heads I win, tails you lose situation. You couldn't lose, and you got 7% for 1 week. And if you annualize that, that is insane return. Andy McConnell, it would be really useful if you could put this stuff in a spreadsheet and explain. Okay, I will figure out how to put it in a spreadsheet and explain it. I think it's going to be next week. I would like these episodes to be around 30 minutes long for now. Yeah. Do you mean that like the option strategies on a spreadsheet, or do you want to see my portfolio and trades in a spreadsheet where you can see where everything is, just so that we are on the same page? And I think Andy is going to answer soon. He says, thanks, mate. If there's any other questions, please put it in the comments. If not, then I will end the stream here. I'm just waiting to see if Andy, the calculations in a spreadsheet. Okay, I will figure something out. Cool, Andy. Thanks everyone for watching. Please make sure you do all the YouTube stuff, like and subscribe. And I'll see you next week. I hope more is going to happen on the portfolio, because I think it's boring when nothing. Okay, next week the Tesla call option is going to expire, so I have to figure out if I write another call, or I might even buy a call option on Tesla before I write a call option. We're gonna see. and phase needs to move. It's been kind of that. If you could explain the in the money put strategy more in depth. Okay, I will figure out a simpler way. It was like the first time I tried to explain it, I think it didn't come out the way I wanted it. So I think next week I will I will focus more on the very deep in the money put options, and if we're at it, we can also look at very deep in the money call options and why they're good and when you would use them. So anyways, guys, make sure you have a fantastic weekend. Tomorrow I have a very special guest on Rocket Lab Weekly, and it's going to be fun. And see you guys in the next video. Ciao, ciao.